In this technical update, we visit Brona MacDougal, accountant and tax advisor with CT. Brona explains the inheritance tax changes which come into effect on the 6th of April 2026, along with tax considerations for your family and farming business.
We're here because there has been a huge amount of change in legislation over the past year and a half. And there's been a cacophony of noise in the media around it, and there's been an awful lot of backpedaling as well, and it's kind of hard to keep track of where we actually are with inheritance tax and other things. So this is a good opportunity for us to kind of consolidate, break down what's changing and how it's changing. So up till now, all businesses and all farms will have had 100% relief for all of their assets and all of their trading entities from inheritance tax, and would never have had to contemplate how am I going to pay for inheritance tax, which had the effect of allowing people to pass on businesses without them having to be broken up, and going to the kids without having to sell any of the farmland or, God forbid, having to move out of the farmhouse and do something else with their lives. As of 30th of October 24, that was thrown up into the air, and the new rules, which come into effect on the 6th of April 26, see a limit to the 100% relief available for farms and businesses generally, and that limit is now 2.5 million per person. Now, if a farmer or a business owner is married, this is going to be very beneficial for them because the 2.5 million can be shared with your spouse, and they can have their own 2.5 million, so together as a couple you have up to 5 million that's fully relieved of business property. Anything over 5 million, and you're going to need to look now at what you can do to make things better for yourself, for your kids, and ensure that your business can be held after your death. So the 5 million allowance covers both business property relief and agricultural property relief. Any value over that limit is only going to be eligible for relief at 50%, meaning that instead of your normal 40% inheritance tax rate, you're going to be charged at 20% on that value. Also, it should be noted that from April 27, pensions are going to also fall into that inheritance tax net. So that's not free money that you're going to be able to pass to your children. This rule isn't going to have such a negative impact on families because all of the inheritance tax money is going to be taken directly from the pot. And what's going to happen is that essentially the kids are going to get less than they otherwise would have. You're not going to have to sell anything or liquidate any assets to pay that inheritance tax, but it should be kept in mind in case you thought that money was going to go towards investing in a business or anything else in the future. There are various ways that people with a value in their estate of over 5 million can make things better for themselves. And so I'm going to discuss some of the options that are available today. In the first instance, you need to determine whether or not the business in the round is eligible for business property relief. That's the first and most important thing. If you have investment assets within your business, there's a possibility that you're not going to get business property relief. So let's look at a scenario. We've got a partnership with mum and dad, and they own a farm. And within that farm, they have their farmhouse at 400 grand. They have farmland that's occupied by sheep. That's £4 million worth of land. They have some farm cottages. Those cottages are occupied by people who work on the farm at the moment, so all used in the business. But they also have a wind farm contract, and that contract is going to extend for 30 years. So the value of that contract is based on all of these future income streams, and it actually amounts to £4 million. They also have some land on a hill that they're not using for the farm at the minute because they're getting a bit older and they don't want to go up there, and their dog has arthritis and all of those things, and that's 900 grand's worth of asset just sitting there doing nothing. So at the moment, the total value of the business is 9.8 million, but over 50% of that business is assets that aren't being used in the trade. And because of that, the partnership isn't going to be eligible for business property relief at all. And if both mum and dad were to die right now, the inheritance tax bill would be 1.7 million. Now, it's quite easy for them to make a change to bring the business into line such that more than 50% of the assets are trading. And then it massively increases the amount of relief that they're eligible for. So what we'd propose in that instance is that the land which isn't occupied for any trading purpose right now, that hill land, is brought back into use in some way. Now, there are many ways that you can still have a trading business while making compromises, and sometimes it'll be yeah, just get a shepherd to look after the land and he has his own dogs and that's grand, everything takes care of itself. You could go down the route of getting easy care sheep, you could go down the route of contract farming, any of these things, so long as you're participating in profit, will be a trading enterprise. You bring that £900,000 of asset back into the trading business, and suddenly the trading business is preponderantly over 50% trading, and business property relief is now eligible on all of those assets, including that extremely large wind farm asset. And ultimately you can bring the tax liability down from 1.7 million to just 700,000. So you can save yourself £1 million just by making sure that all your assets are working for themselves properly. That's always the first step you take before you consider what you want to do about succession planning. But succession is definitely the next route. If you have value in businesses or farms that's over 5 million, think about how you can, at your earliest opportunity, get that into the hands of your kids. It's usually your kids, so that they can take on the business. And it doesn't actually matter if they want to run the business in the future or not. It will still be very much worthwhile them having value in their hands rather than in your estate, because they'll have more money at the end of the day if they choose to sell the business. So what we would do in this situation, same kind of partnership setup, is give some assets to the kids. Now, I'm going to assume in this situation that the kids are over 18 and they can have assets in their own name and income in their own name, that's fine. So you're going to want to give away assets that are fully trading. If you do that, you get capital gains tax holdover relief for trading assets. That's a Section 165 relief. Ultimately, it means that the kids can get those assets. No capital gains tax crystallises up front. And the burden of that gain, let's say the difference between when mum and dad bought the farm in the 60s and its value right now, that gain is passed on to the kids. And if they do sell it down the line, yeah, they're going to be taxed on that gain for capital gains tax purposes at some point in the future. But we don't know what the tax landscape is going to look like then. And ultimately, we know that right now, there's no tax going to be paid. So give them some farmland. You could maybe give them the farm cottages as well. I've done that in this illustration. They get the farm cottages, they get £2 million of land each. And that takes mum and dad down to a position where their entire estates are fully relieved for IHT and they pay no inheritance tax at all. We are kicking the can down the road with the kids, but who knows who's going to get into power next and what the inheritance tax landscape is going to look like by the time the kids have an issue at all, right? So we'll forget about that for the moment. The things that you want to think about practically then when you're gifting to the kids is covering all your bases and making sure that you have no other concerns apart from, giving away value. So the first thing that people are mainly going to be concerned about is retaining control. They don't want the kids to do anything stupid, go off and sell a parcel of land from under their feet without telling them. And there are easy ways to control that. So the simplest way, and it's relatively cheap from a legal perspective, is to put a partnership agreement into place. So a partnership agreement is just an agreement between all the partners that own the assets that says who can do what, who gets what income, who has rights to what capital. And ultimately, in this case, you'd want to say that mum and dad have the right to make all the main decisions. They have powers of veto over all matters. They can determine, let's say, controlled matters or reserved matters like whether they would ever sell up, things like that. So mum and dad can know the kids can never do anything stupid. They just have some value in their hands. The next thing that everyone's going to be interested in, particularly until the point of retirement, is, okay, I'm happy for you to have some value, but I still want my income because I don't have my pension yet. And that, again, is not too difficult to organise. So long as mum and dad are still working on the farm, still doing the lambings or whatever else, going out every morning just to check that everything's all right, they should get paid a salary commensurate with what they're doing. And so that would come off before any partnership profit. The profit is diminished and then split up between the various people who own a capital interest in the business, the kids, essentially, and yourself. By doing this, you are protecting the inheritance tax position, because there is the kind of risk that if you give away a certain amount of capital, but you try and retain income or benefits related to it, that HMRC could say that wasn't a real gift, and actually we're going to forget about it for inheritance tax purposes. It was a sham, and you never made that gift in the first instance. So you can't retain any more benefit than you're entitled to, but you can retain the benefit of a salary if you're doing work that is worth that money. So that's what you do in that instance. You might be in a situation where actually your kids are like 7 and 9 and they have no ability to hold on to an asset or would know what to do with it. So in that kind of a situation, a trust is the best option. So what you would usually do to be both compliant from an inheritance tax perspective and an income tax perspective is set up a discretionary trust that lists all of your children once they've turned the age of majority, so 18, 16 in Scotland. And from that point, they're allowed a right to income and a right to capital. And there will be a transition period where clearly they're 7 and they're not going to be 18 for a while, but the asset will still belong to the trustees. And in this case, you'd make mum and dad trustees. So mum and dad completely control everything. And even when the kids turn 18, they don't need to get anything. They might get some income, they might not. It might actually be handy for you to give them some income while they're in uni that's not your own income previously taxed and just goes straight out to them without tax. So there can be many benefits to doing that, but ultimately they can get it now. You don't have to wait until they're 18 and that 7-year clock can start rolling from today. There can also be the situation where you want to give an asset to one of your children, your son, your daughter, but you're slightly concerned that their marital position is less than healthy. Again, a trust is another very secure, not always going to be completely ironclad when it comes to marital disputes in court, but a very safe way of doing it, certainly if it's a discretionary trust and they have no absolute right to anything. They only have a discretionary right at the discretion of the trustees. Again, mum and dad remain trustees and are in complete control of what's going on there. Finally, the one other hiccup that can occur when you're giving away an interest in the partnership, let's say your partnership includes your farmhouse and you give away 1/3 of your partnership to the kids. You don't want them to have 1/3 of your farmhouse in case, again, they decide to do something stupid with it. So that can also be easily controlled. And that would be 2 ways, I suppose. The partnership agreement would say that actually the kids have a beneficial interest in certain specific underlying assets that don't include the farmhouse. But also you can have that listed in the accounts just to kind of back up the situation. The kids own an interest in the land, mum and dad own an interest in the farmhouse. So everything can be nice and neat and tidy. You can feel secure whilst giving away a whole lot of value. Okay, the next interesting opportunity when it comes to looking at let's say a farm business again that's well over 5 million. If we look at a farm here that has, for example, 10 million pounds worth of value and is currently held by dad as a sole trade, and we want to spread that out between the family, one particularly useful tool here is incorporation. So incorporation means that obviously the ownership becomes subject to directors' control. And there's no one person that has an absolute right to income. Income is determined by voting on what dividends will be issued, what won't be issued. And because of that, company shares and company shareholdings are subject to discounting that a partnership interest isn't subject to. In a partnership, if you say to someone, okay, you're getting a 10% interest in capital and you're going to have a 10% interest in income, they know exactly what they're getting. But if a person has a 10% interest in a company, they can't control what dividend is paid to them. And because they can't control it, they're going to pay less for that interest. This is just how the market would sell an asset, okay? And when it comes to an inheritance tax valuation for a company, HMRC don't take into account the special purchaser, which would be the kid, let's say, buying a 10% interest, knowing that daddy's going to give them a 10% dividend. They're going to value it on the basis of a market value. Random person comes to the family, can I buy 10% of your business? Yes, you can, but I don't know if I'm going to give you a dividend. I'm not sure I even like you. So the valuation aspect of a shareholding is completely different. If we say, take the example of dad has 10 million pounds of farm asset in his hands and he wants to split it out amongst the family after incorporation, he's going to keep 20%, mum gets 10% and all the kids get 10%, 3 kids here. And then they also decide that they're going to set up 2 trusts and each of the trusts are going to hold 20% of the business. Now, in normal terms, the underlying assets that are allocable to each person are just a pro rata division of that 10 million pounds. So dad has 2 million, mom and each of the kids have 1 million, etc. But when it comes to inheritance tax valuation of that, discounts are applied. And these are significant discounts. So ultimately in our situation, mum and dad get a discount of 25%. So dad's 2 million pound interest becomes a 1.5 million pound interest and mum's 1 million pound interest becomes a 750 grand. Each of the kids they only have a 10% interest. Their interests aren't amalgamated because they're not married, and they probably aren't going to work in each other's best interest, may not work in each other's best interest. They each get a 50% discount. So their £1 million assets become a 500 grand value for inheritance tax purposes. And ultimately, you discount the value of the business from 10 million to something like 4.5 million. Money just essentially disappears for the purposes of inheritance tax, and that could be really valuable to some larger farms. I mean, it has other values. Incorporation can give you the opportunity to issue things like growth shares. Again, that would be if the value of the business as a whole was very large. The actual costs of implementing a growth share scheme can be quite significant, but can put an absolute limit on what mum and dad's interest and value in the business is, which is a nice kind of comfort blanket, because obviously the value of land is going to increase over time. And if you're doing this early, you can know, I'm never going to go over my limit because I've put a growth scheme in place. So that's another option. For farms, any farms now over 5 million, the basic principle is 5 million is going to be protected. Try and get rid of the excess value. And actually, what we'd probably advise is, if you're doing this early, get rid of more than that excess. Give yourself headroom in the £5 million allowance. So maybe even go down to something like 4 million if you can afford to, and retain control and retain income. The easiest way, if you have kids, is a partnership. I don't think there would be any particular point in going for an incorporation unless there were other issues at play, like trying to regulate income in the hands of various different people. So partnership's going to be the cheapest option in terms of your legal fees and everything, and will get everything done that you need to do to do your early succession planning. So you want to just give away as many trading assets from the business as you can to take yourself to something like 4 million. That then allows for the next 10, 15 years of your life to bring you up to a £5 million limit with yourself and your spouse, and gets the kids going on the business and makes sure that there's no inheritance tax payable. A partnership is where several people own and control assets together. Now, in Scotland, a partnership is a separate legal entity, and you should always try and have a partnership agreement in place if you're in a partnership, because it's just going to save disputes and costs down the line. The partnership will determine who owns what assets. So in some cases, you'll have a heritable capital account listed in your partnership agreement that will say each person has an interest in particular underlying assets of the business. And it will also say income, people participate in income to a certain degree. And a lot of partnership agreements actually say that people participate in income on the basis that they determine year on year. So you can change your partnership interest year on year. And you can also keep in mind that any of the partners that are participating in profits can also have a deemed salary taken away before those profits are determined on the basis of the work that they do in the business. But it's a great collaborative way of sharing income and reducing the entire family's income tax liabilities, but also here preparing us for inheritance tax situations down the line. If you're starting off in a farm partnership with your family for the first time, you need to be aware of all of the risks as well as the opportunities. You should probably take your own legal advice, review the partnership agreement, be happy with how the allocation of income and profits and losses will be determined between however many of you are in the group. And you should also definitely be aware that all partners share joint and several liability. If there's a claim against the business, that claim could be entirely your burden if no one else had any money to satisfy that claim. You have to make sure that you do your due diligence and read the partnership accounts, I would say, at minimum for the prior 3 years, and understand what it is the business is doing, how much money it's making, and where its liabilities are. Okay, so the 7-year rule is the rule that if you make a gift or if you make a transfer into a trust, you ideally need to survive that by 7 years in order for it to be fully effective for inheritance tax purposes. The gift is within your estate for those 7 years, and so if you were to die in those 7 years, can fall back and impact your own personal inheritance tax position. It can also, if let's say the gift was to your child, the liability for that gift, if it fails, is the responsibility of your child. So if, for instance, you gave them cash and they have actually spent all that cash, the liability initially falls to them and they have to try and find money for that. So that's well worth knowing. Usually when you're just doing one gift, or let's say mum's doing one gift, dad's doing one gift, and things are quite straightforward, you're only looking at the 7-year period, and you can usually say to yourself, I'm never going to make this position worse. The inheritance tax position is only going to get better, not worse. And actually, it can improve from the 3-year point if the gift that you've made is over your nil rate band being 325,000. So if it's over your nil rate band and you survive for a full 3 years after it, taper relief starts to come into play. So you've crystallised some benefit, and that benefit keeps getting bigger until that 7-year point when it's completely out of your estate. There is one situation where if you've maybe engaged in quite a bit of gifting and you've created a trust in your history and then make a direct gift in the 7 years after that, that you can actually disimprove the inheritance tax position by making a gift, which, it's not normal, but you do need to be very aware of this if you've made a trust in the past. It's something called the 14-year rule. And if you're contemplating making a gift and you've already made a trust, go and talk to your lawyer or your accountant about it, because it's a complex rule and it can actually disimprove your inheritance tax position. So you need to check on your timings and look at that. A will is crucially important for anyone running a business in general, but particularly for farmers, and most particularly if there's any kind of tenancy in place over your land. If there is a tenancy in place that your farm engages under, a specialist agricultural lawyer is very important when it comes to writing a will. With no tenancy in place, it's still important that you're going to someone who understands agriculture and agricultural law. Putting a will in place from an early point is extremely important for your beneficiaries and your family, because it could save them thousands and thousands of pounds in legal fees and court costs of dealing with an intestate estate. So there's no point in putting them in that jeopardy. Just get a will in place now and make sure it covers everything that you need it to cover. Regardless of age, no matter what age you are, if you're holding any assets, it's important to have a will in place. Powers of attorney are equally as important when you're running a business with other people, because they will look after both your welfare and your financial interests at a point that you've lost capacity, if that should ever happen. And it provides the other people in the business with the assurance that should anything happen to you, the business can continue, decisions can be made, and particularly in situations like livestock businesses, that you can still get into bank accounts and deal with contracts that you were previously dealing with without any interruption. If you are thinking of gifting away an interest in the business in order to secure your inheritance tax position, but there might be a concern around an in-law, a son or daughter-in-law that you don't particularly want to have control over the business, either in the short term or the long term, you could consider asking your child before they become a part of the partnership to enter, if it's after the point they got married, a post-nup, or before they get married, a prenup. And this will ensure that the land stays within the family, as most people are interested in it remaining. Well, the tax landscape has changed dramatically in the last year and a half. And it would be a good point now to consider, do you know the value of your business? Do you know what you want to do? Do you know what your will says? Is everything up to date? And going to your accountant and going to your lawyer and having these necessary discussions to make sure you protect yourself and your kids in the future. It's important to have a conversation with your family and to understand the intentions of each of your children. Who wants to participate in the business? Are they going to work together? Do they have other jobs that they want to take? Are they going to live somewhere else? There are always awkward conversations when you're talking about wills and death, but they need to be had. By understanding your kids' aspirations, it'll help you in your own decision making. So that's extremely important to have those conversations. Well, this is a simplified summary that we've been through today with a few illustrations, but tax law is complex, and farming and family relations are also complex. So it's really important that you speak to your own accountant, that you speak to your own lawyer, and make an informed decision if a decision needs to be made.